Have you ever found yourself, grappling with this fundamental question in finance today? How do we actually square the timeless wisdom of, say, legendary financial thinkers with all the energy, sometimes chaos, of these new disruptive technologies? Well, today we're embarking on a deep dive into exactly that paradox. We're taking a really fascinating look at how the bedrock principles of Benjamin Graham, I mean, he's widely revered, right, as the father of value investing, how those principles can possibly stand up or even apply to something as utterly unconventional as Bitcoin. Because on the surface, this pairing, it feels like an immediate contradiction. Graham, well, he emphasized intrinsic value, solid earnings, and a really staunch avoidance of speculation. Pretty much swore by it. Bitcoin, as we all know, has no traditional earnings, no dividends, and certainly no clear intrinsic value in that Grahamian sense. So, I mean, how do we even begin to bridge such a seemingly vast chasm? It feels tricky.
Our mission, then, in this deep dive, is to explore how, despite these apparent contradictions, a robust framework for what the source calls intelligent speculation in Bitcoin can actually be derived directly from Graham's core mindset. We're going to try and unpack why someone might even attempt to reconcile these two seemingly, well, disparate worlds. And crucially, if you, our listener, choose to engage with Bitcoin, how it can be done sensibly, with discipline, and importantly, a long-term perspective. Now, it's really vital to state up front that we are absolutely not here to endorse Bitcoin as an investment. That's not the goal. We're here to extract the foundational principles that guide intelligent engagement in any volatile market, really. And all of our insights today are drawn exclusively from our source material, which is titled The Intelligent Speculator's Guide to Bitcoin. By the end of this deep dive, our hope is that you're going to have a much clearer understanding of Bitcoin, but from an unconventional, yet highly disciplined perspective.
You should be equipped with some actionable strategies for managing risk and emotion, and maybe for seeing beyond this, the constant hype that often surrounds this asset. Get ready, because this is going to be a truly thought-provoking journey. Okay, let's just dive right in. Benjamin Graham, this legendary figure, value investing, built his whole philosophy on rationality, emotional discipline, the relentless pursuit of intrinsic value. He famously, almost religiously, warned against speculation. So what's your initial thought, that gut reaction when you hear his name paired with Bitcoin? I mean, an asset with zero earnings, no dividends, often called pure speculation. It just feels like mixing oil and water, doesn't it? What's the guide's take on this immediate tension?
It absolutely does feel that way. You've nailed the core paradox right there. And the Intelligent Speculator's Guide to Bitcoin tackles this tension head on. The initial instinct for many, I think, is just to see an irreconcilable difference. How could Graham, the guy preaching about balance sheets and earnings reports, possibly relate to something so ethereal and, let's be honest, so wildly volatile? But the guide proposes something interesting. It says the reconciliation isn't about trying to sort of force Bitcoin into a traditional Grahamian valuation model because, like you said, it just can't fit. It doesn't have those traditional fundamentals Graham looked for, not at all.
Right. No PE ratio to calculate there.
Exactly. No cash flows to discount. So instead, what the authors propose, and this is what makes this deep dive so compelling, I think, is that it's about extracting Graham's fundamental mindset, his approach, and applying that to a completely different kind of asset. The core idea isn't really to defend Bitcoin as a traditional investment. That's not the aim here, and the guide is super clear on that point. It's much more about presenting a framework, a robust one, for engaging with it sensibly, with discipline, if you, our listener, choose to participate.
So it's for someone who already sees something in Bitcoin but wants to approach it more rationally?
Precisely. This approach is tailored for those folks who recognize, okay, Bitcoin isn't a stock, it isn't a bond, it doesn't fit neatly into a discounted cash flow model, but they might still see it as a potential long-duration bet, a bet on some really profound concepts, maybe digital scarcity or the emergence of decentralized monetary systems, or perhaps even as a hedge against the long-term decay of traditional fiat currencies.
Interesting. So it's a bet on a bigger idea, almost.
Yeah, it's a bet on an underlying narrative, a perceived utility that exists outside the confines of corporate earnings and quarterly reports.
So it's less about what the specific thing Graham invested in, like railroads or whatever, and much more about the how. His whole approach to the market itself. His focus was always risk management, discipline, regardless of the asset class, right?
Yeah.
But how tough is it to maintain that how when the what is just so radically different and, frankly, bouncing all over the place?
That's the crux of it. You've hit it exactly. Graham prioritized intrinsic value because it gave him that margin of safety, that buffer against mistakes and market madness. But his deeper message, the one that truly transcends specific assets, was about how you conduct yourself in the market. It was about operating with a margin of safety, with unwavering emotional discipline, and always, always with a long-term horizon. The guide suggests that if one must speculate, and let's face it, many people will, warnings or not, then that speculation should ideally try to mimic the risk controls and the disciplined mindset of traditional investing. It's about taking the spirit of Graham's caution, his temperament, and applying it even to something like Bitcoin, which he probably couldn't have even imagined.
So channeling Graham's ghost almost to guide your speculation.
Sort of, yeah. And the why someone might engage with Bitcoin is key to understanding this framework. People aren't buying it because it generates revenue or pays a dividend. They're engaging, the guide suggests, because of its unique properties, that absolute scarcity, its decentralized nature, its resistance to censorship, its potential as a global, permissionless store of value. This is the underlying bet that really demands a disciplined approach, because without that discipline, without that Grahamian mindset, it can very quickly just become pure gambling. And that's exactly what Graham abhorred. It's about approaching this totally new paradigm, but with a seasoned, wise perspective, asking not, is this a stock, but, okay, how do I engage with this unique thing intelligently?
Okay, that distinction makes a lot of sense and really frames the conversation perfectly. Before we dive deeper into cultivating that Grahamian mindset for Bitcoin, though, we absolutely need to establish a baseline. What is Bitcoin, according to this framework from the guide? And maybe even more importantly, what isn't it? Because, yeah, it's clearly not a typical stock you'd analyze or a bond throwing off income. How does the guide draw that line clearly?
You're absolutely right. Getting that definition clear is vital for any kind of intelligent approach. And the guide is very direct, very clear on this distinction. It stops us trying to, fit a square peg into a round hole. First and foremost, Bitcoin is not a company. That's the most critical point. It doesn't have operations that produce cash flows. It doesn't host quarterly earnings calls where a CEO talks about performance.
Right, no management team to assess, no balance sheet to audit in the traditional sense.
Exactly. None of that. It operates on a completely different plane. Fundamentally, Bitcoin is an open source software protocol. Think of it like Linux, but for money, in a way. It's maintained by this vast, decentralized network of miners and nodes spread all across the globe. And this network validates transactions, secures the ledger, makes sure everything runs according to the rules. One of its most defining technical properties is its immutable issuance schedule. Meaning the rate at which new Bitcoin are created is fixed in the code. It cannot be changed by any central authority. And this leads directly to its other critical characteristic, that maximum supply of 21 million coins. Ever. That's it.
That fixed cap supply, that's a huge part of the narrative, isn't it?
It's absolutely core. It sets it apart fundamentally from fiat currencies, which can be printed at will, and frankly, most other digital assets too.
Okay, so it's not a business. It's this self-regulating protocol with built-in scarcity. That leads right into that common analogy, the digital gold comparison. What exactly does the guide mean by that? Why is that analogy used so often?
Yeah, the guide explicitly states that, at best, it resembles digital gold. And that analogy is really key to getting your head around its perceived value proposition. Let's break it down. First, like gold, its supply is inherently limited. Gold has to be dug out of the ground, right? Its total availability is finite. Bitcoin's 21 million coin cap provides a similar but digitally verifiable scarcity.
Okay.
Second, also like physical gold, it's non-productive. Holding a gold bar doesn't generate income or dividends, it just sits there. Similarly, holding Bitcoin doesn't generate ongoing returns or cash flows like a stock or a bond might. You don't get a check in the mail for owning Bitcoin. So therefore, its valuation basis is quite different from a traditional company. Its value is largely based on, narrative, on sentiment, and on its perceived utility.
Perceived utility meaning?
Meaning what people believe it can do for them in the long run. Often that's seen as a store of value, maybe a safe haven asset during times of uncertainty, or potentially a hedge against currency debasement, especially when governments are printing a lot of money. It's valued based on belief in its long-term role, not its short-term earnings.
Right. I can almost hear Graham balking at that description, though. Narrative, sentiment, perceived utility. That sounds an awful lot like the pure speculation he warned everyone against.
Yeah.
How does the guide square that? How does it reconcile Graham's likely reaction, given his really strict views on tangible value?
You're spot on, and the guide didn't shy away from that. It concedes that Graham would likely balk at calling this an investment. Absolutely. His entire framework was built on tangible assets, predictable earnings, verifiable intrinsic value. He'd see the lack of those things as a huge red flag, no question. However, the guide suggests that even Graham might concede that if someone insists on speculating because people will have to eat, then it absolutely must be done with immense clarity, with profound caution, and with stringent self-control.
Ah, so it's about the conditions of speculation.
Exactly. This is the core of the intelligent speculator's approach described in the guide. It's a form of speculation that intentionally tries to mimic the rigorous risk controls and the disciplined mindset found in traditional Graham-style investing. I mean, think about it. This is a fundamentally different beast than a company. You can't interview its CEO, there isn't one. You can't read quarterly reports to understand its financial performance, it doesn't have any.
Right.
This distinction forces the intelligent speculator to shift their whole analytical framework away from traditional financial metrics towards understanding the protocol itself, the network strength, adoption rates, and most importantly, focusing inward on their own temperament and their own risk management strategy. It's about acknowledging what Bitcoin is and what it isn't, and then building a sensible approach around that reality instead of trying to jam it into a model where it just doesn't belong.
Okay, so if Bitcoin isn't a traditional investment, and we can't analyze it like a company using Graham's usual tools, how on earth do we even begin to approach it with his wisdom? This is where it gets really interesting for me, because the guide points out, as you mentioned, that the core of Graham's philosophy wasn't actually about picking specific stocks. It was about something much deeper, much more foundational: temperament. That feels like the absolute key here, especially for something as wild and woolly as Bitcoin. How does the guide elaborate on cultivating this temperament?
This is indeed the absolute cornerstone. You're right. And frankly, it's what elevates this whole discussion beyond just, financial mechanics with formulas. The guide really underscores that the intelligent investor, or as we're framing it here, the intelligent speculator, is primarily defined by their emotional and psychological discipline. It's not just about being smart analytically. Graham understood, maybe better than anyone, that human nature, our own emotions, if left unchecked, are the biggest enemy to making rational decisions in the markets. Fear and greed dominate.
Absolutely. Mr. Market.
Exactly, Mr. Market. So let's look at how these core temperament principles, as the guide lays them out, apply directly to navigating the Bitcoin roller coaster. First, and maybe most importantly, the intelligent speculator must be rational, not emotional. Graham's Mr. Market, that manic, depressive partner who swings wildly between euphoria and despair, offering crazy prices well, Mr. Market is definitely alive and well in the Bitcoin world, maybe even more so.
Oh, definitely. 24/7.
24/7. So for Bitcoin, this means resisting that powerful urge to buy into the hype when prices are shooting for the moon, or conversely, to panic sell when they're plummeting earthwards. The guide advises that this rationality translates into a core actionable principle. Never bet more than you can afford to lose. This isn't just some throwaway line. It's the absolute bedrock of risk management here. Given Bitcoin's potential for massive swings, even theoretically going to zero, this is paramount. If losing the amount you've put in would significantly impact your life, your well-being, then you've simply overallocated. You're setting yourself up for emotional torture, making rational decisions impossible.
And that overallocation, that fear of losing too much, is often exactly what triggers those emotional reactions Graham warned about, right?
Yeah.
So resisting the herd must be just as challenging, if not more so, in this space.
Absolutely. Which brings us directly to the second principle: avoid herd behavior. When everyone else is piling in, screaming to the moon, driven by FOMO, that powerful fear of missing out or stampeding for the exits in a blind panic, the intelligent speculator needs to stand apart. They don't follow the crowd, especially when that crowd is clearly acting on irrational exuberance or just abject fear. History shows the crowd is rarely right at the extremes. For Bitcoin, this means tuning out the noise. Ignore the celebrity endorsements, the viral tweets predicting outlandish prices, the sudden surges of retail interest that often mark tops. Your discipline, your rational framework is your shield against that collective madness.
So stay detached from the frenzy.
Detached, exactly. Third, the guide stresses: focus on process, not predictions. Trying to reliably predict short-term market movements, especially for Bitcoin, is frankly a fool's errand. Nobody can consistently time the market. Nobody. A sound, disciplined process, however, is far more valuable because it's repeatable. For Bitcoin, this translates into strategies like using consistent allocation methods, particularly dollar cost averaging DCA. We'll talk more about DCA later, but the key is it moves you away from the impossible game of trying to time the market perfectly. It automates your buying behavior, removes emotion from the decision. That consistency is your process.
Right, taking the guesswork out.
Precisely. And finally, number 4, maintain a margin of safety. Now, this concept needs some reinterpretation for Bitcoin, as we'll discuss, because there's no traditional intrinsic value. But the concept itself, protecting against downside risk, creating a buffer, remains absolutely critical. In the context of Bitcoin, this translates into very tangible actions, like never ever borrowing money to buy Bitcoin, using leverage, margin loans, whatever. It magnifies both gains and losses. In an asset as volatile as Bitcoin, leverage can lead to catastrophic, irreversible wipeouts. It drastically increases your risk of ruin. Graham would absolutely abhor this. It violates the core principle.
So it's really about building this robust internal framework, this mental defense system, to counter all that external chaos. And that chaos isn't just the price swings, is it? It's the constant media noise, the endless stream of short-term predictions.
Exactly. That brings us to a really critical practical application of these temperament principles. Ignore short-term price predictions and media hype, seriously. Most of what you see and hear in the news or flooding social media about Bitcoin is just noise. It's often designed specifically to provoke emotional reactions, fear, or greed, which, as we know, lead to terrible decisions. The intelligent speculator needs to develop filters. They filter out this noise and stay focused on their long-term thesis, their predefined plan. The ultimate goal, and the guide puts this really powerfully, is that Bitcoin speculation, when done intelligently, is not about timing the market, it's about surviving it.
Surviving it. Wow.
Yeah. It's a powerful mantra, isn't it? And it aligns perfectly with Graham's whole long-term, patient, survival-first approach. It's about weathering the storms, writing out the inevitable cycles, and letting your underlying thesis, if it's sound, play out over years, not days or weeks. Honestly, the psychological challenge inherent in Bitcoin's 247 highly emotional, globally accessible market makes these temperamental rules even more critical than in traditional markets, arguably. Without this deep discipline, speculation in Bitcoin can so easily just devolve into pure gambling, fueled by impulse, hope, and ultimately regret. It's a constant internal battle against our own human nature.
Okay, that mental framework, that Grahamian temperament, is clearly foundational, absolutely essential. But how do we translate this, philosophical grounding into concrete, actionable stakes? The guide doesn't just leave us hanging with mindset advice, right? It provides clear guidelines on actually doing things, managing risk, how to buy, securing your assets, even thinking about taxes. Let's dive into those practical pillars that an intelligent speculator needs to build on.
Exactly. This section is where we move from the why and the how to think to the what to do. It outlines the practical elements of intelligent speculation, taking that philosophical mindset and turning it into actionable steps you can actually implement to stay disciplined and manage risk effectively. So, first pillar, 4.1, strategic allocation and risk management, the 1-5% rule. We touched on this, but let's really unpack it. Graham's central insight, maybe his most important one, was that intelligent investing is fundamentally about managing downside risk. It's not about chasing the highest possible gains at all costs. It's about protecting your capital first.
Survival first.
Survival first, absolutely. The guide highlights why this is especially incredibly true for Bitcoin. We know it can swing wildly. 50% or more in a single month isn't unheard of. This extreme volatility means that proper sizing of your position, how much you allocate, isn't just important, it is absolutely critical. Get this wrong and you're sunk. So, the guide outlines a common, intelligent approach, the 1% to 5% portfolio rule. This gives you a spectrum, a range for recommended allocation based on your personal risk tolerance and overall financial situation. For someone very conservative, perhaps just dipping their toes into the space, maybe a 1% allocation of their total investment portfolio is appropriate. That's it. For those with a more moderate risk appetite, maybe comfortable with a bit more volatility, the guide suggests allocating 2% to 3%.
Okay.
And for the more aggressive speculator, but still crucially, someone operating within a disciplined, rational framework, a ceiling of 5% is recommended. No more.
So even for the aggressive type, it's still a relatively small slice of the pie.
A very small slice. And this allocation is described in the guide as an asymmetric bet. Let's think about what that means. If Bitcoin, for some reason, a black swan event, regulation, whatever collapses to zero, becomes worthless, Your maximum loss is capped at that 1 to 5% of your total portfolio. Now, losing 5% is painful, nobody wants that, but for most diversified investors, it's not financially ruinous. It won't destroy your long-term financial goals. However, on the flip side, if Bitcoin performs extremely well, if its underlying thesis plays out and it gains significant adoption or becomes that digital gold, that small 1 to 5% allocation could potentially grow significantly. It could double, triple, maybe even more, becoming a much larger weight in your portfolio over time.
So limited downside, potentially large upside. That's the asymmetry.
That's the asymmetry. It offers that potential for substantial upside, while strictly limiting your downside risk. The key, the absolute core principle here boils down to never overexpose. This rule directly manages the impact of Bitcoin's extreme volatility. It allows you to participate in a potentially transformative asset if you choose to, without risking your entire financial future. It's the practical quantification of that only invest what you can afford to lose principle we discussed earlier.
Okay, that makes perfect sense for sizing the bet. So once you've set that allocation, you know your limit. How do you actually go about acquiring the Bitcoin in a way that aligns with Graham's wisdom about, well, not trying to time the market?
Right. Great question. That brings us directly to the second pillar, 4.2, disciplined accumulation, dollar cost averaging, DCA. Graham deeply understood and often repeated that timing markets is a fool's errand. It's tempting, everyone wants to buy low and sell high, but consistently getting it right is practically impossible. So the intelligent speculator doesn't try to predict the absolute bottom or the absolute top of a market cycle. Instead, the guide strongly advocates embracing dollar cost averaging, or DCA. This is a simple but powerful technique. It involves buying small, regular amounts of Bitcoin, say $50 or $100 worth, over a consistent period, like every week or every month, regardless of what the price is doing at that exact moment. You just set it up and let it run.
Regardless of price, even if it feels high or low.
Regardless of price. That's the discipline. The advantages of DCA are really significant, especially in a volatile market like Bitcoin's. First, it dramatically reduces emotional decision-making. You're not agonizing over is now the right time to buy. You're just executing your predefined plan. It takes the emotion out. Second, it helps you avoid those common traps. Trying to buy the dip perfectly, which almost never happens. Or, even worse, getting caught up in euphoria and buying at market tops right before a crash.
We've all been tempted by both of those.
Haven't we all? Third, DCA effectively smooths out your average purchase price over time. When the price is high, your fixed dollar amount buys fewer Bitcoin or fractions of Bitcoin. When the price is low, that same dollar amount buys more. Over the long run, this averages out your cost basis, mitigating the risk of buying everything at a peak. And fourth, it builds your position gradually. This minimizes that feeling of regret if you try to time a big lump sum purchase and get it wrong. DCA aligns perfectly with the psychological discipline Graham advocated. It transforms the chaotic, unpredictable nature of the market into a routine, disciplined, and predictable process for accumulating your position.
Okay, so DCA handles the buying strategy. What about once you own it? You mentioned security earlier, pillar 3.
Yes, pillar 3. And this is absolutely crucial, often overlooked, but potentially the most important practical step. 4.3, mastering self-custody. Not your keys, not your Bitcoin. This is a mantra you hear a lot in the Bitcoin space, and for very good reason. Many people, especially when they're starting out, buy Bitcoin on an exchange like Coinbase or Binance or Kraken, and they just leave it there. It seems convenient. But the guide stresses, and the broader community emphasizes, that custody who actually controls the private keys to your Bitcoin is paramount.
Why is leaving it on an exchange so risky?
Because exchanges, while useful for buying and selling, are centralized entities. They hold your Bitcoin for you. This makes them attractive targets for hackers. We've seen major exchanges hacked, losing billions of dollars worth of customer funds over the years. They're also subject to regulatory changes. Governments could freeze assets on exchanges. Or the exchange itself could suffer from mismanagement, technical failure, or even go bankrupt.
Like Mt. Gox, way back when.
Exactly like Mt. Gox, or FTX more recently. Funds stored on exchanges can literally be wiped out overnight. Gone. This point ties directly back to Graham's profound emphasis on security and capital protection. If you're going to speculate, your absolute first duty is to protect your principal, protect what you own. So the intelligent speculator, according to the guide, must learn and practice self-custody. This means taking direct control of your private keys. The guide details the most secure methods. The gold standard is using hardware wallets. These are small physical devices, like a ledger or a Trezor, that store your private keys securely offline. This makes them highly resistant to online hacks, malware, viruses.
So the keys never touch the internet directly.
Precisely. Transactions are signed offline on the device itself. For more advanced users, or those holding significant amounts, the guide also mentions multisig setups. Multisig stands for multi-signature. This requires multiple separate private keys, often held on different devices, or even by different trusted individuals to jointly authorize a single transaction. It's like needing, say, 2 out of 3 keys to open a bank vault. It adds layers of security against single points of failure, like losing one key or one device being compromised.
That sounds robust.
It is. And finally, underpinning all of this is securely backing up your seed phrase, sometimes called a recovery phrase. This is usually a sequence of 12 or 24 words that the hardware wallet gives you when you first set it up. This phrase can be used to regenerate all your private keys and recover your funds if your hardware wallet is ever lost, stolen, or destroyed. Extreme care in storing the seed phrase is absolutely essential. Writing it down on paper and hiding it isn't enough. The guide recommends storing it offline, perhaps etched onto metal plates, split into parts, stored in multiple secure locations, maybe using a safe deposit box. You have to protect that seed phrase like it's the keys to your kingdom, because it is. The core principle here, the ultimate expression of security and true ownership in the crypto space, is simple but profound. If you don't hold your private keys, you don't own your Bitcoin, period. Your ownership is only truly real when you, and only you, control those keys.
Wow. That's a huge point, and maybe a bit intimidating for newcomers, but it sounds non-negotiable for anyone serious about this. Okay, so we've covered allocation, buying, and securing. What's the final practical pillar? You mentioned taxes.
Exactly. The often ignored but critical final pillar, 4.4, navigating the tax landscape. Understand the rules. This is another area where intelligent speculators absolutely cannot afford to be complacent or stick their heads in the sand. The guide highlights, quite rightly, that Bitcoin taxation differs significantly across various countries and even sometimes within regions or states. The rules are complex, they vary wildly, and they are constantly evolving as regulators try to catch up with the technology.
A moving target.
Very much so. Ignorance of the law, as they say, is never an excuse. And for the intelligent speculator following Graham's principles of prudence and foresight, understanding your local tax laws isn't just a good idea. The guide frames it as a fundamental duty. Getting this wrong can lead to significant future legal headaches, financial penalties, audits, things that can completely undermine any gains you might have made from your speculation. To give you a sense of this variation, the guide provides a few snapshot examples. In the USA, for instance, Bitcoin is generally treated as property, so selling it triggers capital gains tax. The rate differs depending on whether you held it for less than a year, short-term, taxes ordinary income, or more than a year, long-term, lower capital gains rate. In Germany, interestingly, if you hold Bitcoin for over 1 year, any gains might be completely tax-free for individuals. That's a huge difference. Then you look at Portugal, which, at least when the guide was written, was known for having no tax on personal crypto gains for residents under certain conditions. Contrast that with the UK, where capital gains tax applies above a specific annual exempt amount, or Brazil, where gains above a certain monthly threshold, around $35,000 per month, according to the source, are taxable.
Wow, yeah, that's all over the map.
Completely. These examples just underscore the critical need for individual research based on your own specific location and circumstances. You absolutely have to understand the rules where you live and operate. Graham, with his focus on sound financial management, would undoubtedly insist that intelligent speculators treat the law, including tax law, as an integral, non-negotiable part of their overall financial framework. Ignoring taxes isn't intelligent, it's reckless, and invites future trouble. It's part of managing your overall risk.
Okay, we've talked through the practical steps, the rules of engagement allocation, DCA, custody, taxes, but let's be really honest here. The emotional toll of Bitcoin's volatility can be just immense. It's not just a theoretical risk on a spreadsheet. It's a daily, sometimes hourly reality for anyone watching the charts. It's one thing to read advice like accept volatility, but anyone who's actually held Bitcoin through, say, a 70% drawdown knows that's far easier said than done. I feel like you need the emotional resilience of a Zen master. How does Graham's timeless wisdom help us navigate what the guide actually calls this circus? How do we stay rational when the market is screaming, both up and down, all around us?
You're absolutely right to bring it back to this, because this is where the rubber really meets the road. It's precisely why Graham's insights on temperament become even more critical, arguably, than any specific tactic. This brings us right back to that cornerstone principle we started with. The Bitcoin market, with its rapid, often gut-wrenching swings, plus that constant 247 barrage of media noise, social media hype, and influencer shilling. It is a supreme test of emotional resilience. It feels like it's almost explicitly designed to exploit our deepest human fears and greeds, pushing every psychological button we have.
It really does feel that way sometimes.
It does. So, pillar number 5, if you will, is 5.1, emotional resilience. Ignore the circus. The guide is quite blunt, explaining how Bitcoin's volatility can feel like emotional torture for most people. It's not just the price swings themselves, but how the surrounding ecosystem, the media, influencers, even friends and family sometimes amplifies these booms and busts with incredible hyperbole. They weave these narratives of guaranteed instant riches on the way up or impending doom and total collapse on the way down. All of it designed to grab attention and, crucially, evoke strong emotional reactions.
Fear and greed, basically.
Fear and greed on steroids. Graham, if he were advising us today on Bitcoin, would offer counter-advice that cuts directly through all that noise. He'd likely tell you first. Never read headlines without context. Headlines are crafted for clicks, for sensationalism, not for providing a nuanced, comprehensive, or balanced understanding of what's actually happening. They simplify and distort. Second, he would hammer home. Never act on hype or fear. These are incredibly powerful, primal emotions. They cloud judgment. They invariably lead to poor, impulsive decisions made at precisely the wrong time, buying high out of FOMO, selling low out of panic. When you feel a strong emotion about the market, that's usually the worst time to make a decision. Step away. And third, never invest or speculate based on price alone. Price is merely one data point. In a market as driven by sentiment and narrative as Bitcoin's often is, price can be extremely misleading. A high price doesn't automatically mean it's valuable or sustainable, and a low price doesn't necessarily mean it's a bargain. Context is everything.
So how do you actually achieve that detachment when the noise is everywhere?
Well, the path to detachment, as recommended by the guide, is actually remarkably simple, though not necessarily easy. It involves setting up an automated, disciplined approach. First, write down a simple plan. Define your thesis for why you're engaging with Bitcoin, set your allocation limits firmly, and articulate your long-term goals or holding period. Put it in writing. Second, set those allocation limits, that crucial 1/5% rule we discussed, and commit to sticking to them no matter what. Third, automate your dollar cost averaging. Set up those regular buys through an exchange or service and then try not to tinker with it. Let the automation handle the execution. And fourth, and this might be the most powerful but hardest part, walk away. Seriously. Disconnect from the daily or even hourly price charts. Limit your exposure to crypto news cycles and social media feeds that just churn out noise. The less you expose yourself to the constant stream of emotional triggers, the easier it becomes to stick to your rational, predefined plan. The guide uses a great phrase. Emotional detachment is the speculator's armor. Removing yourself from the day-to-day fluctuations, the constant pings and notifications and dramatic headlines, protects you against making those impulsive, costly mistakes driven by fleeting emotions. Speculation, without this deep emotional discipline, this armor almost inevitably devolves into pure gambling, fueled by the roller coaster highs of gains and the devastating lows of losses.
That makes perfect sense. Build the plan, automate the execution, and then build a psychological fortress around it by tuning out the noise. Okay, but what about Graham's other absolute core concept? Margin of safety. We keep coming back to it. How does that apply here? If the guide itself says there's no intrinsic value in the traditional sense for Bitcoin, how can you possibly have a margin of safety? Where's the buffer?
That's an excellent, crucial question, and it gets to the heart of adapting Graham's ideas. This leads us to 5.2, rethinking margin of safety for Bitcoin. You're right. In traditional investing, the margin of safety is that comfortable gap. Graham insisted on the difference between the market price of a stock or bond and its carefully calculated conservative estimate of intrinsic value. It's your buffer against errors in judgment, unforeseen negative events, or just plain bad luck. But here's the fundamental challenge for Bitcoin, as the guide unequivocally states. In Bitcoin, there is no intrinsic value in that traditional calculable sense. There are no earnings, no book value in the same way, no assets you can easily tally up in value. So how can this absolutely crucial concept possibly apply? You can't calculate a gap if one side of the equation is missing.
Right. So what does the guide propose?
The guide explains that for Bitcoin, the concept of a margin of safety needs to be reinterpreted. It can't be a price-to-value calculation. Instead, it acts as a set of proxies or practical buffers against financial ruin rather than that quantifiable gap. These proxies serve the same purpose as the traditional margin of safety, protecting you from catastrophic loss. So, what are these proxies? First, the guide suggests that buying below recent highs can provide a psychological buffer. Now, this doesn't guarantee you're buying cheap, not at all, but psychologically, buying when the price is, say, 30% or 50% off its all-time high feels less risky, less like you're chasing the peak of excitement. It can reduce the mental burden and regret if the price drops further after you buy. It's not a value indicator, but a behavioral aid.
Interesting. A psychological margin almost.
Exactly, a psychological margin of safety. Second, and far more importantly, using those small allocations, our bedrock 1 to 5% rule acts as the crucial capital buffer. This is your primary financial margin of safety. By strictly limiting your position size, you limit your maximum potential loss to a predetermined, manageable percentage of your overall portfolio. If the worst happens and Bitcoin goes to zero, you are not financially ruined. This is the most direct application of never betting more than you can afford to lose. It's quantifiable risk management.
So the allocation is the margin of safety in a capital sense.
In a very real capital sense, yes. And third, the guide suggests that holding long-term to absorb cycles acts as a temporal buffer, a time-based margin of safety, if you like. Bitcoin's history, short as it is clearly marked by dramatic boom and bust cycles, huge run-ups, followed by deep corrections. By committing mentally and strategically to a long-term holding period, years, not months, you allow time for these volatile cycles to potentially smooth out. You give the underlying thesis, whatever it may be, digital gold, network adoption, time to actually play out. Instead of getting shaken out by short-term price swings and panic, you're using time as your buffer against volatility.
Letting time be your ally against the volatility.
Precisely. Now, the guide is very clear. These substitutes the psychological buffer of buying below highs, the capital buffer of small allocation, and the temporal buffer of long-term holding. They don't offer the same kind of guaranteed protection that a traditional margin of safety might provide for a fundamentally sound, undervalued business. You can't calculate it in the same way. But they function as potent proxies for Graham's fundamental underlying principle: never risk ruin. They are all designed with one primary goal: to protect your overall financial well-being, even when you're engaging with an asset as inherently volatile and unconventional as Bitcoin. It's about intelligently managing the consequences of the risk, since the nature of the risk itself, lack of intrinsic value, high volatility, cannot be easily eliminated or calculated away.
Okay, we've navigated the disciplined mindset, the practicalities of allocation, buying, custody, taxes, and even the psychological battle in rethinking margin safety. Now let's talk about the end game, or perhaps the lack of one. When does an intelligent speculator, following this framework, actually consider selling their Bitcoin? And just as crucially, what are the absolute no-go zones? The guide seems quite emphatic about certain traps lurking in the wider crypto space that could completely undo all your careful, disciplined efforts. What should people be actively avoiding?
Right, this final section really brings it all together, clarifying the long-term perspective and highlighting the significant pitfalls that the intelligent speculator must consciously steer clear of to protect themselves. So first, 6.1. When to sell? Never, unless you have to. This might sound surprising, but it aligns with Graham's general philosophy. Graham, as we know, wasn't a fan of frequent trading. His focus was always on long-term value, on holding quality assets for extended periods, letting the value compound. He saw excessive trading as speculation bordering on gambling. For Bitcoin, applying this logic, the guide suggests the intelligent speculator's default stance should ideally be to never sell. Hold it as that long-duration bet, potentially indefinitely, unless specific, compelling, and predefined reasons arise that directly impact either your overall financial plan or, critically, the underlying fundamental thesis of Bitcoin itself.
So, hodling, as they say in the crypto world, but for rational reasons.
Exactly, the HA dealing, but with a plan and clear exit conditions, not just blind faith. The guide outlines a few legitimate selling triggers where a sale might be considered intelligent and rational within this framework. The first, and perhaps most common for successful long-term holds, is rebalancing after massive appreciation. Let's say you started with a 3% allocation to Bitcoin. Years go by, Bitcoin significantly outperforms everything else in your portfolio, and now it represents, say, 20% or even 30% of your total net worth. At that point, it might be prudent, intelligent even, to rebalance. This means selling some Bitcoin, maybe enough to get back down to your original target allocation, or perhaps a slightly higher one like 10%, and reinvesting the proceeds into other assets. This locks in some gains, reduces your concentration risk, ensures you don't become dangerously overexposed to this one volatile asset, and realigns your portfolio with your original risk tolerance.
So selling not because you think Bitcoin's going down, but to manage risk because it went up too much relative to everything else.
Precisely. It's disciplined risk management, not market timing. The second legitimate trigger is much simpler. If your personal financial situation requires liquidity, life happens. Unexpected events occur. You might need funds for a down payment on a house, a major medical expense, a job loss, starting a business, funding retirement. If your personal circumstances genuinely change and you need the capital, then selling some Bitcoin, or any other asset for that matter, is a perfectly rational decision. This isn't about trying to time the market. It's about meeting your real-world financial needs.
Makes sense. Life comes first.
Absolutely. And third, and this one is fundamental, you might sell if the thesis is broken. This is critical. You need to have defined why you are holding Bitcoin in the first place. What is your thesis? Is it digital gold, a hedge against inflation, a future payment network? If something happens that fundamentally undermines or invalidates that core reason, then it's intelligent to reassess and potentially exit your position.
What would constitute a broken thesis, though? That seems subjective.
It can be, but the guide suggests thinking about major structural changes. For example, if the Bitcoin protocol itself suffered some kind of catastrophic, unfixable technical failure that compromised its security or core functionality, like its fixed supply, that would break the thesis for many. Another example could be a truly global, coordinated, and effective ban by major governments that fundamentally undermined its utility, adoption, and ability to function as intended. Or perhaps the discovery of a catastrophic security flaw that couldn't be patched and destroyed confidence permanently. These are extreme, arguably low probability scenarios, but they represent fundamental breaks. If your core reason for holding Bitcoin in the first place is demonstrably and permanently compromised, then continuing to hold might no longer be intelligent speculation. It might just be blind hope. Otherwise, the guide's default strategy is clear. Holding through volatility is the best strategy. Selling too early, reacting to short-term price drops, or FUD, fear, uncertainty, and doubt, can easily kill those potential long-term asymmetric returns. You risk missing out on the massive upside that was the entire point of the small asymmetric bet in the first place.
So hold tight, rebalance if needed, sell if your life requires it, or sell if the fundamental reason for holding disappears. That's a clear, long-term mindset. Okay, now what about those traps? The guide seems quite blunt about the dangers lurking in the wider crypto ecosystem beyond Bitcoin itself.
It is indeed blunt, and necessarily so. This is absolutely crucial for anyone venturing into this space. Part 2 here is 6.2. Red flags. What the intelligent speculator avoids. The guide is very candid, stating that the broader crypto space, everything beyond Bitcoin basically, is full of traps. It's an incredibly innovative area, yes, but also largely unregulated, highly speculative, and unfortunately ripe for scams, poorly designed projects, and initiatives designed to separate inexperienced people from their money. Graham's principles, even if not directly applicable to valuing these other tokens, provide an incredibly strong filter for avoiding the noise, the hype, the scams, and the truly dangerous ventures. His focus on prudence, understanding, and avoiding complexity is invaluable here.
So what are the specific red flags the guide warns against?
The guide lists several specific things that the intelligent speculator, following a Graham-inspired approach, should actively avoid. First and foremost, leverage. As we discussed, this means borrowing money, going on margin, to try and magnify your potential gains. But it also, and far more dangerously in volatile markets, magnifies your losses to potentially ruinous levels. Getting liquidated on a leveraged position is common and devastating. Graham would absolutely condemn this. It violates the margin of safety, capital preservation principle in the most extreme way. Just don't do it. Second, derivatives on crypto, especially complex ones. Futures, options, perpetual swaps, these are sophisticated financial instruments. While they can have legitimate uses for hedging by professionals for the average speculator, they often introduce layers of complexity, opacity, and extreme risk. They can be confusing, highly leveraged, implicitly or explicitly, and prone to sudden, massive losses. They generally contradict the intelligent speculator's focus on simplicity and understanding.
Stick to the basics, essentially.
Stick to the basics. Third, the guide warns against yield farming and related complex DeFi, decentralized finance strategies. This involves locking up your crypto assets in various, often experimental protocols to earn seemingly high returns or yield, essentially lending or staking them in intricate, interconnected ways. While some DeFi protocols might be legitimate, many yield farming strategies are extremely complex, opaque, susceptible to smart contract bugs and hacks, rug pulls, impermanent loss, or outright capital loss if the underlying protocol fails. They are often incredibly risky and very difficult for even seasoned experts to fully understand and assess the risks of. If it looks too good to be true, it probably is.
Okay, high yields often mean high hidden risks.
Almost always. Fourth, meme coins. This is a big one. These are cryptocurrencies created often literally as a joke or based on internet memes like dog coins, cat coins, whatever is trending. They typically lack any fundamental utility, serious development team, long-term vision, or sound tokenomics. Their value is purely 100% speculative, driven entirely by social media hype, coordinated pumps, and the hope of finding a greater fool to sell to. They are classic gambling vehicles, not intelligent speculation. Avoid them like the plague. And finally, related to meme coins but broader, avoid influencer-driven FOMO. That fear of missing out, amplified by social media influencers promoting specific coins or projects, often because they were paid or given early access, is a direct assault on rational decision-making. It bypasses all the discipline principles we've discussed: research, understanding, risk management, temperament. It leads directly to emotional, irrational decisions driven purely by the desire for quick, easy riches. If someone is hyping a coin excessively online, be extremely skeptical.
So basically, be wary of anything promising easy money, anything too complex, or anything driven purely by hype.
Exactly. The guide's ultimate guiding principle here, the golden rule for navigating this complex space, is crystal clear and echoes Graham perfectly. If you don't understand it, don't buy it. Period. Simplicity is intelligence. If you can't explain clearly how it works, what the risks are, and why it might have long-term value, then you shouldn't be putting your capital into it. Sticking to what you can understand is a hallmark of intelligent engagement, whether investing or speculating. Hashtag outro game.
Wow. We've really journeyed through a truly surprising connection today, haven't we? Bridging the timeless wisdom of Benjamin Graham with the very modern, often bewildering phenomenon of Bitcoin. We've seen how Bitcoin, though clearly not a traditional investment in that Grahamian sense, can, according to this guide, indeed be approached with Graham's profound discipline. We covered that critical distinction of what Bitcoin is essentially a decentralized software protocol with mathematically fixed scarcity, and maybe more importantly, what it isn't. It's not a company with earnings or dividends to analyze.
Yeah, and crucially, we explored how to cultivate that intelligent speculator's mindset, the absolute priority of rationality over emotion, focusing on a sound process like DCA over trying to make predictions, and the importance of avoiding that dangerous herd mentality. We detailed the practical pillars too, that vital concept of risk management through strategic allocation, particularly the 1-5% rule, and the power of disciplined dollar-cost averaging for accumulation. And we didn't forget the absolute necessity of mastering self-custody, not your keys, not your Bitcoin, and of course understanding your tax obligations in this constantly evolving landscape.
We even delve deep into that psychological battleground of volatility, showing how cultivating emotional detachment really is your armor, and how that core Graham concept of margin of safety, though it needs reinterpreting for Bitcoin, still serves its crucial purpose: to never ever risk ruin, using those proxies, psychological capital, and temporal buffers. And finally, we discussed the long-term vision, where holding is the default strategy, barring specific triggers like rebalancing or a broken thesis. And we illuminated those many red flags and traps: leverage, complex derivatives, meme coins, influencer hype that the intelligent speculator must consciously and diligently avoid in the wider crypto space.
Absolutely. The essence, I think, the core takeaway from this guide really boils down to this. Bitcoin may never pay a dividend. It may never fit neatly into a traditional valuation model that Graham would recognize. But its unique properties, that undeniable scarcity, its global decentralization, its resistance to censorship, these make it fundamentally unlike anything else we've seen in finance before. And for the intelligent speculator, according to this source, that profound difference isn't necessarily a reason to dismiss it out of hand, but rather a compelling reason to approach it with immense care, with a healthy dose of skepticism, and with unwavering Graham-inspired discipline.
It's fascinating. The guide concludes, rather provocatively, by saying it's not investing, but it's not gambling either, if done right. That leaves us with a really interesting thought, doesn't it? What other seemingly unconventional assets or opportunities out there, maybe in tech, maybe elsewhere, if stripped of their hype and approached with these rigorous, time-tested principles of discipline, risk management, and emotional control, might reveal unexpected avenues for intelligent engagement? What truly separates reasoned speculation from reckless gambling in any arena, financial or otherwise? And how can applying this kind of disciplined, rational mindset to any complex area of knowledge transform potential chaos into reasoned, deliberate action? What stands out most to you, our listener, from this deep dive today?